Hey guys, Tim Melvin coming to you from down here in Central Florida. Monday morning of what's going to be a great week, Speed Week over in Daytona. I've got some friends going over. I'm gonna skip it this year. Just got too much stuff going on around the house. Um, Going to be in the 80s all week, getting back up into some nice warm weather. Welcome relief after being up in Baltimore in 35-degree temperatures with sleet and ice last week. I will confess that I enjoyed that not even one little bit as far as the weather goes. Company was great, weather not so much. So real nice to be back down here in Central Florida and got at least a week or two with no travel plans. So we're just going to kick back and enjoy it. Might even go over to the beach for this upcoming weekend. Anyway, was at the Money Show when I got back from Baltimore. Always go to the Money Show. It's where I get all my pens and office supplies and all that. I will admit to a certain amount of disappointment this year, as most of the people in the exhibit hall, that the swag game was very poor this year. Just not a lot of giveaways. My wife was very upset because every year the Options Industry Council and a couple of the big fund firms have given away those big plastic clips, supposedly for documents. I guess we use them for potato chip bags. She was low on those and wanted a couple, and just really bad swag here at the Money Show. Walking around the exhibit hall, it's the same stuff. It's the swing trading system. It's the option trading system. It's the get rich quick in an hour and a half. And people are going to spend money on it. They're going to sign up for the courses and the seminars and the videos, and they're not going to make any money. Guys, if you really knew how to make that much money that fast, you'd never tell a soul, much less sell it for $199. We make money the old-fashioned slow way. It's not rapid. It's not going to happen overnight, but we build a huge margin of safety into it, and I think we have a lot of fun along the way. But get rich quick sure does seem to still catch everybody's eye. Now, as you walk around the Money Show, there's an overwhelming urge as you walk through the halls listening to people talk, and they all own the same stocks, and they're all doing the same thing. You just want to give them a good slap and say, hey, guys, do you really think you're going to outperform the market by doing the exact same thing that everybody around you is doing? And to keep in mind, according to most of the research surveys, what all you guys are doing as retail investors is underperforming even the rate of inflation, much less stocks and bonds over the last 2 decades. Slow down, take a longer view, realize that price matters, and it matters a whole lot. And more, we're going to touch on that here more in a little bit. And you'll be way ahead of the game and on the way to outperforming the market. So anyway, we had a couple dinners with some good friends. The highlight for me was watching Mark Skousen and Peter Schiff get into it, with Skousen calling Schiff everything but an idiot, bit of a shouting match. Schiff was, doom and gloom, and the world's going to end, and buy gold and that sort of thing. And Skousen was having none of it, and it was absolutely hysterical to watch. Anyway, market was fun last week, wasn't it? Big swings, a couple huge down days. People got a little bit scared. Lots of explanations, of course. The experts have been out. They're telling us why it happened, right? And the overriding view is that everything is still right in the world. This was just a couple of low volatility funds that blew up, making bets against the VIX ever going up again. So when the VIX did go up, they were too leveraged and they blew up and they caused this huge collapse in the stock market. And it's a great story. The problem is it's not true. There's nowhere near enough money in these low volatility products. There's about $5 billion total in the inverse volatility exchange traded notes. And we estimate about $50 billion total in low volatility hedge funds. Now, they didn't make things better once the selling started. I will give you that. But the selling really started because people are starting to look around, and the economy's it's better than any of us thought it would be, because everybody, including yours truly, was kind of the mindset that we were going to see lower for longer, that we'd be lucky to see 2.5% sustained economic growth. And, right now the Atlanta Fed model, which is reasonably accurate, it's showing a 4% GDP growth for the fourth quarter. That's down from the 5% it was forecasting in January. But if you look at the numbers that are coming in, things are running a little hotter than the Fed expected. There is a mindset out there that says, hey, if the economy is going to do better than expected, then we could see rate hikes from the Fed at every meeting this year. And 4 rate hikes on the short end could cause some selling on the long end. We could actually see interest rates move up for the first time in 7 or 8 years in a meaningful fashion. And that's going to cause asset repricing. So I think what happened last week is we saw a little bit of selling start. It was caused, by just, hey, assets could reprice. We've got some huge gains in this stuff. Let's go ahead and step aside. When that started, you saw some of the indexers starting to get out of the market, and we've talked about that ETF effect. ETF selling leads to more selling, caused volatility to spike, blew up some of the low volatility guys, and that turned into those big, fun one-day routes that we saw last week with very high levels of volatility. Will it continue? I don't know. I hope so. Right? I mean, I'm the crash cheerleader. I'm sitting here. We've got a good cash position. We would absolutely love to see a 20-25% decline in stock prices. That would be a birthday present come a couple months early for me. But we'll see how it all plays out. Again, position in our portfolios, in the main portfolio, lots of cash, tail hedge in place, lots of small banks, average price to book value of the portfolio is about 1.25%. We like where we are right now. So, speaking of the urge to slap somebody, bad advice is everywhere apparently these days. We went out to dinner Friday night, just a small place not far from the house here, not associated with the Money Show or anything like that. So we're just out, a little Mexican restaurant, and tables are pretty close together. It's a fairly small establishment. And I couldn't help myself. I wasn't trying to eavesdrop, but at the table next to us, there was a guy, and he was talking to a family. Young adult daughter with her parents, and they were talking money. And it became obvious to me that this guy was a financial advisor who was trying to sell them on his service and strategies. And as I sat there listening, my wife was actually kind of restraining me because she could see I was about to jump into this conversation. It was making me crazy. Because this guy, the advisor, he was good. He got them to talk about, risks and how they viewed things. And these were very risk-averse, conservative people who, they wanted a safe, secure return on their money. Long story short, this guy weaves back and forth telling stories, and his suggestions, he's selling them a non-listed REIT because that's completely safe. No matter what the market does, you're just going to get your dividends every month. Everything will be fine and wonderful. Doesn't mention those 15 to 20% fees off the top. The fact that it's a blind pool of real estate, you have no idea where the money's going. And oh, hey, by the way, this isn't illiquid. It's not liquid. You can't get your money out most of the time. So that was part of the solution. And the other part of the solution was indexed universal life, because that way you could invest in the stock market and get all of the upside, but you had a floor. So no matter what the market did, you would still earn a 1 or 2% return. Guys, that is just not how that product works. If you can come out of that after fees, with a 2 to 3% annualized return, and that would only happen in a runaway bull market like we've seen over the last 9 years, then you should count yourself lucky. Huge commission products, terrible performance, lots of risk, and I don't know if I was proud of myself for not jumping into the conversation or a little bit ashamed, like I'd watched someone beating up a little old lady and didn't do anything about it. The point of all this is, guys, bad advice is all over the place out there. One of the things that we've tried to do with Banking on Profits and Community Bank Stock Investor all along is to educate as well as give you some advice and suggestions on which banks to buy. I want you to be in a position so that if I walk out and I get hit by a truck tomorrow, you guys will be confident in your own abilities to carry on with what I've taught you over the last couple of years. Hopefully, we're doing a pretty good job of that. I like to think so. Lots of bad advice. If it sounds too good to be true, odds are it is. So let's be careful out there and do the research and do the homework. Now, I got thoroughly chastised over the weekend by an associate as we were talking about investing and investing approaches. And this guy's much more of a trader than I am. And we were having dinner after he had given his presentation at the Money Show. And he was talking about my style. I said, well, in everything we do, we kind of look and view the world kind of like a private equity investor. I mean, even with the community banks, we're buying underperforming community banks that have an activist presence, a strong balance sheet. We're buying them for less than book value, and we're willing to hold them for several years. That's kind of the definition of a private equity investor. And if you recall, when we first started out, a lot of our banks had private equity investors in them that had come in and taken extended positions during the credit crisis to bail some of these banks out. We ended up doing very well with those. I wish we'd see it again. But no, Tim, you can't use that phrase, private equity. That's a bad phrase. That's got all the negative connotations. Remember when Mitt Romney was running for president, and private equity was just demonized because they killed jobs and they cut pensions and they just did bad, horrible things, and basically robber barons killing the public and taking advantage of the poor public in the name of the almighty dollar and profit. I said, wait, back up a second. Okay, first off, I know a lot of private equity guys. I kind of cover and follow private equity pretty closely. So let's look at what private equity really is, and let's try to take some of that bad label off of it, because I'm going to continue using the phrase private equity mindset, and I'll continue talking about private equity-like investing, because you know what? That's how you make money in the market. So we're going to talk about that. Private equity. When they come in, they buy a company. Now remember, this is going to be an underperforming company. They are the activist presidents, the private equity firm themselves, and they're looking to buy it at a great price, improve operations, and sell it at a huge profit. So some companies you come in, the problem is they're just not in good shape. They've made a lot of mistakes. Staff is bloated. They've hired too many people. They've diversified the business. So, okay, you're going to have to make some changes here. And the changes are going to involve laying some folks off, letting some people go, cutting some divisions, and doing some other things that might not be that great. But look, when they get the business back on track, what happens? Then you have a profitable business. It's paying taxes. It's contributing to the community. It's probably going to create some jobs. But just as often in the private equity situation, you come in, you have a smaller company, private equity comes in, they provide the cash to grow the company. That's going to create jobs. So sometimes they destroy jobs, sometimes they create jobs, but they do create profits. I get it. Profit's a bad word, but let's be honest about something. Whether the business is a bank or makes cotton candy machines or automobiles or whatever they make, if there's no profit motive, it never happens. There are no jobs with no profit motive. I grant you, it's gotten excessive over the last couple of years. The gap between CEO and average worker pay bothers me as much as it does anybody else. I think the income equality question is a serious one plaguing the United States, but let's not put all that on private equity's back, okay? Marty Whitman used to be called a vulture investor. In the 90s, when it was a much more profitable game, I was called a vulture investor from time to time because we would buy distressed assets and hope that the company was eventually liquidated by the bankruptcy courts at a profit. Somebody asked Marty how he felt about being called a vulture investor. He said, I don't care what you call me, as long as you don't call me an asset allocator or an indexer. I feel exactly the same way about the private equity style investing. I think that it's a fine way to look at the markets. I don't really care what you call it. Just don't call me an indexer. I'm right there with Marty on that one. Okay, on the reading front this week, remember I told you when I was reading the latest in the Serge Storm series, The Pope of Palm Beach, that the lead character in there, Serge Storms, was on his literary tour of Florida. And one of the authors he mentioned was Charles Willeford. So I said, you know what, those books sound pretty interesting. I'm going to check them out. So he has a lot of books. He's a very prolific writer. But the first series I checked out was the Hoke Mosley series. They're set in Miami. It's a 4-book series. I'm about halfway through them. I got to tell you, the hard-boiled noir game is strong with this guy. These books are fantastic. Set in Miami, following a police sergeant through his day in life in the streets of Miami. These things are really fun to read. On the nonfiction side, working on Ron Cherndale's Washington. This is a fantastic book, guys, and really informative, interesting. There's a lot more to George Washington than chopping down cherry trees and crossing the Delaware River. I can tell you that. This is a good read. I highly recommend it. If you have not read it, you should jump into that. Now, big day for me down here in Florida. Tomorrow, over in Sarasota, pitchers and catchers report. Later this week, the Braves pitchers and catchers report here in Florida. I think they report on Wednesday. On the 23rd, first spring training games of the year will be played. On the 26th, the first spring training game here in Orlando over at Disney Wide World of Sports will be played. I highly suspect I'll be there. But anyway, after a long, long winter, baseball is finally back. Lots of questions for the Baltimore Orioles this year. We have 2 pitchers in the rotation at this point in time. I don't know if we're going to trade for some. I hope not. Dan Duquette's done a horrible job of trading for pitchers. We do have some young guys in the in the minor leagues that I think could come up and start and do a lot better than some of the guys we brought in over the last couple of years. The lineup looks okay. There's some weakness in there. Chris Davis might need to up his dose of Ritalin so he can get back to 2016 form. We'll see how it all plays out. But at long last, baseball is back, and I am pretty excited about it. So, no idea what the market's going to bring this week. We are up. I had to check and make sure we are up as I am videotaping this morning. We'll see how the week plays out. I think that if we should close down today, that won't be great for the market. And by the way, this is all just intellectual exercise because, as subscribers know, the odds that I'll make any changes to the portfolio based on market action are, well, they're not just pretty close to zero, they are zero. The numbers tell the story for us. They've been telling a very good story. They're going to continue to tell a very good story. We've had 2 bank deals so far this year. I think, thanks to tax reform, we're going to see a lot more before the year is done and have another fantastic year in banking on profits and the community bank stock investor. So anyway, I've got to go take a walk down here in this 83-degree sunshine temperature down here, take the dog for a little stroll. So I'm going to finish up here, and I will talk to you guys next week.